Hi guys, welcome back to my channel. Kelvin here. The other day, I was browsing Reddit looking at funny animals when I came across this post. Titled, "Afraid to exceed my positions." He says that right now, most of his stocks are at all-time high now, and he feels that they are overvalued. If he sells right now, aka paper hands, he will have enough money to pay off the mortgages. But at the same time, he is worried that the market will go even higher. I think that most of us are in the same situation right now. Even if we have bought stocks anytime within the last 1 year, most of them will be at all-time high right now. Other than AMC and GameStop, they are not at all-time high yet. Anyway, I wanted to share what will I personally do in this situation. Is it better to sell? Is it better to hold? I will also back it up with real data because science. Not only that, I also share a better way to handle this problem because yes, there's a better way. But before I start, I would really appreciate it if you can help to tap the like button because it would help out with the channel a lot. In return, I will show you a cute puppy. Alright, let's not waste any time and let's start right now. Let's get the big elephant out of the room first. In the post, he mentioned that if he sold, he will make enough to pay off his family mortgage. Absolutely don't do that. Sure, by paying off your loan early, you have no more debt, but you also have no more money. All these 10 years of your effort will be gone. Just like that, the bankers will be like, and he thought he can save on interest by paying off his loan earlier. The reason you shouldn't pay off your loan early is because mortgage interests are super low right now, at just 1+%. Take as long as you can to pay off the loan. The reason is your money can easily grow much more than just the 1+% mortgage interest. And by letting it grow, you will end up with more money in the end. Okay, with the elephant out of the way, let's get to the real problem. It's true that markets are at all-time high right now. As of making this video, the S&P 500 is at $4,509. Many of the stocks like Google, Facebook, Apple are also at near the peaks. And if we check the S&P 500 PE ratio, we can see that it's super high right now. Over the past 100 years, the average PE ratio was around 15 to 16, but now it's at 35. The last time the PE ratio went super high was around 2007 to 2008. That was right before the financial crisis happened. As a result, the market dropped by 57% during that period and it took over 3 years to recover. Right before that, it was around year 2000. That was when the dot-com bubble popped, just like our Singapore-Hong Kong travel bubble. So, never name your plan as bubble because it will always pop. Anyway, when the dot-com bubble popped, the market dropped by almost 50% and it took over 7 years to recover. So yeah, it seems like bad things will always happen whenever the PE ratio goes super high. Besides PE ratio, there's also our Warren Buffett scorecard indicator, where he looks at GDP, the green line, versus market cap, the blue line. So the past 2 times the market cap went past GDP, it went back down. And right now, not only he has went past, the market has more than doubled the GDP, signaling that the stocks are way too expensive right now. So there's no doubt that the market is really expensive right now. In fact, it has become way more expensive than a Chai fan with fish. On top of that, many analysts and blogs are predicting that a crash will come soon. For example, a guy named Harry Dan predicts that the stock market crash will come within 4 months. Jim Rogers warns of bubble by the end of 2021. Even Motley Fool also thinks that the crash is coming too. So, to put the long story short, there's a lot of evidence that suggests that the market crash could really come. But I'm not too worried. First, no one really knows where the market will go in the short term. And anyone that tells you that they know is lying. Jay Bowman compiled a chart of S&P 500 versus pundits, which shows that every month there's someone shouting that a crash is coming. Paul B. Farrer, the real crash is dead ahead. Harry Dan, since crash in Q3 2013. Mark Faber, something will happen. And the market just kept going higher and higher. Then you'll be like, what about the PE ratio or Warren Buffett indicator? Remember when there was a big crash in 2020 and the Fed be like, I'm going to print so much money that it's going to look like the unlimited money cheat code in The Sims. They didn't really say that, but that's what happened. Just 40% of US dollars in existence was printed in the last 12 months. And the Fed has said multiple times that they won't anyhow raise interest rates and they will continue to buy bonds every month. This means interest rates will remain low, which is really good for companies' growth because companies can continue to borrow money cheaply, which will help them grow faster. So yeah, the market is overpriced, but that's because interest rates are low and the market is being supported by the Fed. Right, there's a chance that the market crash could come, and there's also a chance that the market crash would not come. Or in other words, nobody knows whether a crash will come or not. What can you do? Let me show you 2 scenarios. First scenario, you sell everything and the market crash. Yay! You managed to time the market perfectly. You are now a god of investing like our Warren Buffett scorecard. let's go celebrate and eat some chili crab. But before that, let's take a look at some data. From 1928 to 2020, you will notice in the worst case, the market has gone down like 50% like 2 or 3 times only. And the worst return in a year is around 50%. Sure, there are many times that the market has dropped by 5% or more. But at the worst case, there's only 5% of the time that the market has dropped by over 40%. On average, over 93 years, the average drop in a year is only 17%. So technically, if you were to sell today and the market crashes tomorrow, you'll be able to avoid a 17% loss on average. But maybe you're like, hey, this is S&P 500 leh, is everything leh, maybe I buy Apple stock leh? It's actually quite similar. Apple's worst drop was around 2009, reaching negative 60%. But on average, it's also around 20% drop in a year. Same thing for Amazon. I could go on and on comparing all the stocks drop in a year. My point is, if your stock is a good stock like Apple, Google, Amazon, best case scenario, you will be able to avoid 50% loss based on history. But on average, you will only avoid 20% loss. However, if it's meme stock like GameStop or AMC, then we have a problem. But judging from the post, I don't think that's the case. Second scenario, you sell everything and the market be like, Chong ah! You miss out on all the gains and be like, no! Let's look at some data. First, throughout history, the market has gone up 74% of the time. So essentially, if you are betting that the market will drop, there's only 1 in 4 chance that you'll be right. Second, if you are investing immediately or doing dollar cost average, you'll get a good return. If somehow you are hardcore and can time the market perfectly, you will only get a slightly better return. But chances are, you are not hardcore and you have bad timing, you will end up with a much lower return. There's this belief that if you buy the dip, your return will be higher. Like if you can time the very bottom, you'll be a rich boy by now. But the data shows us that this is not the case. It was found that investing at all-time highs over long term actually gives you better returns than if you invest on any day. If you buy and hold after the market crashed 30%, the return is actually lower than if you just buy and hold after the market declined 10%. Here's another one. If you stay fully invested, you will have the highest returns. But if you just miss the 10 best days from 1999 to 2018, remember, it's just 10 days out of 20 years, your return will drop by more than half. Miss 20 best days out of 20 years, you will start to lose money. And what makes it harder is that 6 of the 10 best days happens within 2 weeks of the 10 worst days. The most recent example was in 2020 when the market was falling like nobody's business. Immediately after that, the market gave really good returns. Here's another one. If you only try to buy the dip, you will perform much worse off than someone who just buy and hold over the long term. So yeah, there's so much data that shows that if you try to cash out right now and wait for a crash, you will get a much lower return over the long term. Sure, past performance doesn't guarantee future performance, and probably this time is different. But personally, I would trust 90 years worth of data. So after seeing so much data that shows that trying to buy the dip is a bad idea, what should you do? Here's my non-professional for entertainment purpose only advice from a person who is still learning about investing. So take it with a huge pinch of salt because I totally don't know what am I doing. All the data tells me that just by buying and holding, I would do better than trying to buy the dip. If I do not need the money within the next 10 years, I will activate my diamond hands and just hold it. Instead of selling, I will continue to dollar cost average. Market up, I buy. Market down, I cry a little bit and I buy more. Because by selling, sure, I can probably avoid a 20% average loss, but at the same time, I will potentially miss out on a lot of gains. I think the dilemma that the Redditor faces is that he feels that his portfolio is just sitting there like a lazy bum and doing nothing. It's not giving him any income or anything. So to overcome this, I would recommend to use an option strategy known as covered call to generate a consistent income from the portfolio. Remember, this is not financial advice. I'm not telling you to do that, yeah? I won't go too deep into the cover call strategy, otherwise this video will be longer than the Avatar movie. You can check out how I do cover call on my portfolio if you are interested. But basically, cover call is just you selling call options on your stocks. And by selling call options, you get to collect money every time you sell. If the stock goes above the option strike price, you have to sell 100 of your stocks at the strike price. Otherwise, the option will expire worthless and you get to keep your stocks. Then you can keep repeating selling covered calls over and over again while collecting money. How I did it is by selling call options that's very far out of the money. Instead of selling at the normal 0.3 delta, I will sell it at 0.1 delta or even lower. In case you're blah and don't know what's delta, basically at 0.1 delta, it means that there's a 90% chance that this option will expire worthless. So by selling at lower delta, it will reduce the chances that you will have to sell your stocks. but at the same time allow you to collect a decent amount of cash every time you sell an option. Again, I'm not telling you to do it. Maybe this strategy will perform worse off, maybe this will perform better, I don't know. But personally, that's how I would do it. I will not sell off my stocks, instead continue to dollar cost average, then sell calls on my portfolio for consistent income. Alright, and that's all for today. What's your suggestion? Would you sell at all-time highs or would you hold? Let me know down below. Like, share and subscribe as I'll be posting new videos every Monday, Wednesday and Friday.